Hello and welcome to this episode of Nucleus Wealth and Power. I'm Shelley George, Chief Operating Officer at Nucleus Wealth, and I'm coming to you today from the lands of the Gadigal people of the Eora Nation. So transparency is an important facet of the social way humans live. Whether it's in business, government, or work, it's important for both decision making and accountability. And that's no different when it comes to your investments. Unfortunately, though, more investments than we'd like are opaque, especially in superannuation. So today we're going to look at why this matters to you and what you can do about it. And to help us do this, we've got Nucleus Wealth's Chief Investment Officer, Damien Klassen, as our guest. Welcome, Damien.
Hi, Shelley.
All right. Did you know that Nucleus Wealth is an active and passive investment manager focused on bringing clients personalized and transparent investments? As part of that transparency, we love bringing you content, and you can help us to continue to do so by subscribing, hitting the like button, or clicking the YouTube bell to be notified when there's more. Also, please keep in mind that any advice discussed in this show is general in nature, and it's not going to relate to your specific personal circumstances. But if you would like to discuss anything with us, you can get in touch with us on 1300 623 863 or contact@nucleuswealth.com. All right, transparency is the best place to start with an example of, Damien. What is transparency? Transparency investments.
Yeah, sure. So I think the main problem there's two elements to the whole transparency. One part is what do you actually own, and for a lot, I get for a lot of people they're sort of saying, well, I've got a fund manager, it's their job to do that for me, or I've got a super fund, I don't care as much. I sort of get that, but I in a way, it's the part about saying I want that to be available if I want it. It's the part about saying, well, what have you really got to hide from me? And it's that part that can be a bit concerning in terms of the transparency. Is it's just that the governance part is if your asset manager has to has to be a top secret as to what they own, and it takes ages for you to work out, then the question is is there enough probity, and are they doing what they should be doing in terms of finding that? So that's one part. The bigger part that I think comes out to play is in the pricing, and that's the part where you can get caught because you're putting your superannuation in every month or every week or whatever it is into this super fund, and $1,000 hits the account, and it's a question about saying, well, they're going out and buying $1,000 worth of assets. Now, what is $1,000 worth of assets? For some markets, it's really clear. Like if you're buying stock market things on the stock market, well, there's a price. It's listed. We know when they say they're buying $1,000 worth of assets, they're buying $1,000 worth of assets. The problem comes when they say, okay, we've just sold you, Shelley. You've given me $1,000. I've just sold you, $1,000 of an airport that I happen to own myself, or it's a unlisted asset, and I'm telling you what the valuation of it is. And there's no public markets for it. That might have fallen, it might have doubled in price, and I'm giving it to you at a great discount, or it might have halved in price, and I'm giving it to you, I'm selling it to you, at an extremely inflated price, and that is your money going in there every week or every month. That's actually making that difference in terms of what you're paying for these assets and the returns you get from them.
All right. So I feel like within that, part of what's important, not all of it, but is also the pooling structure of superannuation funds. Do you want to talk through why that's important?
Yeah, so there's a couple of different ways you can invest in superannuation, and you have companies like ourselves where what we do is the assets sit in your own name. So if you buy a BHP share, that is your BHP. It sits under custody, but it's been tagged to you, and you know what price you bought it at, and that's your capital gains, and doesn't really matter what other investors do in my fund. That's yours to go with. So what most of the older superannuation funds are, though, is most of the older ones have this pooled structure where basically they've bought BHP, you've come into their fund, and they've sort of notionally allocated you a bit of that BHP, but if other investors come in and go out, and they buy and sell and buy and sell and buy and sell, your that BHP share that you own in there has, because it's turned over, that's actually created capital gains events. And so the fact that you sat there and didn't do anything with that share for 20 years, well, you didn't actually get the capital gains benefit of that, because the company had to keep paying the capital gains every time they bought and sold and jumped in and out. So there's so that's one problem in the pooling structure. And then the other problem, one of the benefits of the pooling structure is it does let you buy some of these unlisted things. So your superannuation fund might have gone and bought 40% of an airport or a toll road or something like that, and allocated that between its members. Now that's it was sort of pushed as a very good thing years ago, because it was, what would happen with those assets was those assets tended to be underpriced, because they were illiquid and they were sort of off market, and so you got some good returns from them, because what would happen is you could buy this airport cheaper than what you might have been able to do otherwise, and because it was illiquid and you're hard to trade. The thing is, what finance industry is very good at doing is finding inefficiencies and getting rid of them. And so there's now dozens of different ways you can buy these types of assets, and most of them are listed and all that type of stuff. So the returns you get on these assets now, you're basically you're getting similar returns to what you'd get in a listed market, but they're not listed; they're illiquid, and so you're sort of paying the penalty without getting that return pickup. In my view, which is an issue. So I've veered a little bit off, and we'll come back to that point later. But the idea is, I guess, in a pooled structure, your money's mixed with everyone else's, and there's these capital gains things going on, or other effects going on that that can affect the value of your investments based on what other people are doing, not based on what you're doing. And to use a more extreme example of that is, let's say you're in a super fund and it gets some bad headlines, and 20% of people leave your super fund. So what might have happened was, let's say you've bought an airport, and they bought that airport at $10 billion, and something's happened, and that the value of that airport's shrunken, and now it's only worth $6 billion. Is that but your company hasn't recognized that, your superannuation company hasn't recognized that. So that airport's now part of that fund. If all these people are selling out and they're giving the people that are selling out the value of that airport at the full, at the price you bought it at, not the real price, is what's happening is, they get to clear out without taking the loss that they should have taken. And I'm actually ending up with more airport, because 20% of people have just left. So now I own more of this airport, all priced at the high price, rather than at the real price for that. And so that's where you can get, so I guess the danger is, I'm sort of doing nothing with my super, or just being a good customer and just sort of letting the managers do their job. But the actions of other investors is actually affecting the value of my investments.
So you can get a wealth transfer effectively from different investors as a result of that pooled structure, and it's more pronounced when you have a significant number of people moving one way or the other, right?
That's
sort
right.
of like runs on banks, it feels like.
And also, it's more pronounced with that, but it's also much more pronounced with unlisted assets.
Mm-hmm.
And more Australian super funds are putting in, greater proportions of unlisted assets. And we've even seen, in recent days, we've got a lot of headlines out about the government talking about superannuation and helping superannuation, encouraging superannuation companies to invest in the housing market and national infrastructure and these other factors. And the more you get of that, well, that's going to end up with more unlisted assets in the superannuation sector. So making that whole problem worse. When it was 2% of your superannuation was unlisted assets, it's like, well, it doesn't really matter. When it turns into 30, 40, 50% of your superannuation, is like, well, now my whole valuation of the super fund is based on what the managers, they're marking their own homework and saying, I did a great job this quarter. These assets did whatever in terms of price, and there's a tendency for management to make things look better.
Well, I mean, if you look at where the incentives are in that structure, it's either the superannuation fund directly holds the assets and they're responsible for valuing it. And absolutely, there's guidelines within finance around how you should be valuing these assets, but it's pretty murky. You can get pretty wide ranges.
And with everything, there's a matter of judgment. And so, I can look at companies and say, well, here's a company I bought. It's gone down in price, but you know what, I really think it's worth a lot more. I'm going to hold on to it, and eventually it'll come back. And the thing is, because I've got market prices for that, it's gone down in values. That's the price I have to take. I can't say, well, I bought this stock for $3 and it's gone down to $2, and I really think it's worth $5, so I'm going to keep it in my books at $3 because I really think it's going to be worth $5.
Mm-hmm.
And I have to acknowledge the fact that the market's just marked it down to $2. And eventually, if it does come back, great. I get marked down, and then I get marked back up again if I'm right. In an unlisted thing, you can just make that argument because there's no, you haven't got a direct price that you can't argue with. It's all about saying, well, what's your impression, and what's your, there's a range of different variables it could be, and you can be, more optimistic and more pessimistic in your assumptions, and these values can vary, extremely widely from one end to the other. And so, and think about it like the house. You want to sell a house, you talk to the real estate agent. The first thing they do is they tell you, oh, one of your neighbors just sold sold a similar house for $2 million, and you're like, oh, fantastic, I'd love $2 million. And next thing you list your house, and they're like, well, yeah, but that house had all these other features and planning permission and whatever, and you're going to get 1.6. And so there's this wide range of like, well, what's reasonable, what depends on who you ask.
Or it depends on who's there on the day to buy it, right? Which is a similar thing for these unlisted assets.
Yeah, and there is incentive as well. You start running into these problems with, okay, so you're let's say, Shelley, you're the person who's doing independent valuations for a super fund.
Sure.
And the super fund, I'm the super fund manager, and I want my returns to look good. And I hire you, and you keep marking the value of my assets down to the most pessimistic version possible. I'm like, well, that Shelley's not really working out. I'm not really convinced that she's that competent.
I'm getting fired.
I'm going to go with somebody else. I'll choose somebody else. I'll choose somebody who's on the optimistic side of everything, and then my returns look better. And it might be worse for my investors, but for me as a manager, I want somebody who's going to mark my homework and give me A's rather than go, well, no, this is the best you can get, a B plus. So
yeah, well, I mean, because most investment managers will have a bonus portion of their income or salary, and that's going to be tied to performance.
Yeah, and look, or there's just the fact that if you keep coming in with poor results, eventually you lose your job. So there's direct immediate effects of like, okay, I might be able to get a little bit more, a pay rise or a little bit less or whatever. But there's also that longer term,
All right. So one of the questions I have about this idea of comparing, valuations of shares to unlisted assets is often, not always, but often in an unlisted case, in a superannuation fund, they're actually a majority holder of the asset. So, one of the criticisms, the argument that we're putting forward here might be that we're not accounting for that added benefit of having control of the asset. What would you say to
that? Is that, everyone's got high opinions of themselves and their abilities, and most fund managers I know haven't run large businesses. They haven't actually been, a high level manager in a corporation with thousands of people. Usually, fund managers are quite small operations. You're talking about staffs in the dozens. Even if you are a big fund manager, that sort of would be directly reportable to you. And so, why would a fund manager, be better at running an airport or a a property trust than a management company that was actually designed around that, or a listed airport that's their entire role. And so of course I've got great admiration for my own work, and I'm sure I could do a much better job than all these other people, but the reality is I probably couldn't. I don't have any expertise in running these things, and I don't know why super funds think that they do have expertise in running these things.
Yeah.
And so so I think that control element is overstated. And I think as well that it actually leads potentially to more perverse incentives in terms of sticking with stuff for much longer, because the costs of getting in and out are so much higher. So it's the idea that saying, well, if I'm an investment manager and I'm taking my view upon whatever the assets are, and I'm buying in or buying out, and I need to be able to accept the fact that I'm going to make a lot of mistakes. nobody gets 100% of their calls right, and if you're getting 50 or 60%, or sorry, 55 or 60%, you're doing quite well as an asset manager. And so when you're making a large proportion of your portfolio, it's about saying, well, in that portion of the portfolio, it's about minimizing my losses. It's about saying, when I make a mistake, I need to be able to work out, I've made a mistake, I need to cut and get on to, move on to the next asset. If it's an unlisted asset where I'm a 40% shareholder and I've got managerial rights and there's all these things, that is all embedded in me, it is much, much harder to get out of. And it's also, people are just, from a behavioral point of view, is it's about saying, oh, okay, well, this went wrong. Okay, maybe if we fire this person and get somebody else in, and maybe we have a new policy on whatever it is, and maybe this will fix it or turn it around. And so you've got investment managers trying to make, again,
They're too
managerial
close.
decisions.
Yeah, right.
They're too close to the problem. Yeah. And
Okay.
it's they're predisposed to try and predisposed to try and hold on and not admit to mistakes, if that's the case. Whereas I think the best investment managers are the ones who are happy to change when and are willing to admit that they've made a mistake and move on.
Yeah, right. So the distance helps with that. So one thing that just raised for me was, this idea of selling. You're talking in that example about selling entire stakes, really. But the example you gave earlier on, where you said, if a super fund had some bad news come out against it, and a lot of people wanted to leave, like imagine the Optus breach situation with a super fund, right? You might see some similar things. 20% want to get out, right? It's also really hard to sell the unlisted assets in portions. So, there's a lot less interest. Certainly I get the impression that they appreciate that, having that control. So, you did actually mention in your example that, the existing people would have a higher proportion, but I think it's kind of worth reiterating that specificity around it's a liquid.
So let's use that example as saying, so let's say you've got a fund that's got half unlisted assets and half listed assets, and they get a breach. As you said, breach comes out, may or may not be their fault, but it does come out, and 20% of people decide to leave the fund. So now I can't sell the unlisted assets, so I've got to sell the listed assets. So now I go, you sold 20%, or of your listed assets, you've sold 20% of your overall fund to fund those people, and it's got to be all the listed assets. And so now I've got 30% listed assets and 50% is all that's left. And you scale that back up and you're like, okay, well, now all of a sudden I've got way more unlisted assets than listed assets. And if I've either got to try and start selling those unlisted assets and taking losses and paying that cost, the extra cost it costs. It's not just a trade on a stock market and we're done and we're out and it's cost.
No, it's a discount when you have to sell something, when it's a fire sale, the vultures will be picking over the carcass.
Yeah, but it's not even, and that's one part of it. But it's also that if I want to sell, like if I'm selling, say, a BHP share, I might be paying 0.05% on that share sale. Like it's almost nothing.
As a commission, you mean, like the actual trading costs? Sure,
is the actual trading cost.
They're huge. Yeah.
If I have to sell an unlisted asset, I'm going to be paying probably 5% at least, and then there might be stamp duty issues and all these other factors. Like you could be easily at 10% of the value of the asset to sell the asset because these things are so illiquid. They need all these legal agreements. They need brokerage to find an actual buyer and seller and all that type of stuff. And so they're hard to get out of. That just all adds to that extra cost that you've got to pay for these things.
So, we've talked quite in depth about what some of the issues are, but what I'm really interested in talking about now is, why do super funds like these so much? I mean, there's some challenges there, obviously, but they've been getting more and more into this asset class since at least post GFC in 2009, 10-ish. And you were just saying, Chalmers is talking about more, encouraging them to do more. So what's going? Where's the love affair?
Yeah, sure. So look, there's a whole bunch of different areas, and might have to ask me this question again so I can remember what things I've missed. But so the first one is risk and return. So super funds get judged on how much volatility is in the value of their fund versus how much return they're getting.
Do
That's
they
one of the key
really?
measurements.
Who measures them on the risk? Because as a consumer of superannuation products, I don't feel like
Okay,
I'm doing that or seeing
individuals.
that.
No, but if you look at any of the groups that are doing assessments in terms of your Morning Stars
All
and
right.
Van Eyck's and all the people who are actually sitting down and saying, okay, we're running an analysis on, is this fund manager doing a good job or not?
Okay.
Almost all of them start with, what's the risk versus the return?
Okay. Thanks.
And the thing is, if I've got an unlisted asset that I've put in my books, so I've got my unlisted asset and my listed asset. My listed asset's gone up 10%, down 10%, up, down, up and down over a course of a year, and it's ended up at zero. I've got this other unlisted asset, which is my book, and I haven't changed the price at all over the whole year. So it's got no volatility at all in it. And I've got this other one that's been up and down and up and down. Now, the reality is this unlisted asset, wasn't worth zero. Didn't sit there the whole time. It probably did go up and down with the stock market. And if I actually did want to sell it, I would have had to take that. I would have made the gain or made the loss.
And so when you're saying zeros in this example, you mean growth, right? Not the value of the asset, the change in the value of the asset.
Yeah.
Right. Cool.
Yeah. And so what that means though is when you do your calculation, if you've got half unlisted assets and half listed assets, all of a sudden you look like you're a lot less volatile
Okay.
than somebody else who's in the who's just been invested in the stock market the whole time. And so then when the asset consultants look, they go, oh, isn't this a much better asset? It's less volatile. And it's like, well, no, it's not less volatile. It's just you don't see the volatility. And so and anyway, but that's a second order effect that they don't get to. It's just
do they get to it now? Because obviously it was a brilliant strategy before 2020. And then we had such a big market correction that no one could stop looking at this sort of the car crash that never happened in the unlisted space. Like, surely it has more acknowledgement now. Or that wishful idealistic thinking.
Yeah, I do think it's wishful thinking. I think there's amongst the more educated and more intelligent, analyzers, yeah, absolutely, they do that analysis and say, no, this doesn't work out. But amongst the very basic analysis, and then analysis, you get taught in CFA courses and things like that, then that's this is the analysis. I put the numbers in. I got the return series. I put it into the series, and this one's less volatile than this one. Therefore, therefore the less they got the same return for less volatility. Therefore, it's a great fund. And you do your Sharpe ratios and your Sortino ratios and all these other bits and pieces that are just standard calculations. And none of them have this question about, well, were they unlisted assets? They're all just like, plug the numbers in, spit it out the other end. Here's my answer.
So they're basically taking the valuation of the portfolio at a fund level. They're not looking at it asset by asset level, and it's whatever the company, it's whatever the fund manager reports to them, right?
It's gaming the system. It's basically saying, this is the way I'm going to get scored, and so therefore I can modify things so that my score looks good, despite the fact it might really be worse. Okay, so
it reduces risk. One.
Another element is you can control. So there's one benefit. Another one is, to a certain extent, you've got a bit more control over the leverage within your funds. Now, superannuation funds in particular can't use leverage.
Yep.
But it's a bit weird in that, okay, I can't use leverage as a superannuation fund, but I can buy a company that is using leverage. So there's that certain part of it, but if I'm buying now an unlisted asset that is sitting in a vehicle that is using leverage, so say it's an airport and they've got their own debt versus that airport, now I am allowed to do that. Now the question is, can I then modify things so that I've actually got a bit more debt or a bit less debt sitting within that asset? Because I'm sitting on the management committee, I can now decide that, well, maybe you shouldn't run an asset. Other people might look at that and go, oh, it's an airport, whatever, it's reasonable to have 50% debt or 60% debt, but too much more than that's, but I'm like, well, this is an unlisted asset sitting in my fund. I've got lots of liquidity. Maybe I'll run it at 80% because I might want to use that. I might want to use that leverage to buy other assets and get it and generate a better return for my.
What reporting standards require you, if you have a certain amount of control of the asset, that you actually have to push through all of that balance sheet onto yours? Or does Australian regulators not like IASB or something? I can't actually remember off the top of my head.
Yeah, usually over 50% you do, but under 50% you can get away with it, and it depends upon how and look, you're right in that you push it to the extreme, and yeah, you can't do that. But I guess what I'm saying is, if I'm using unlisted assets
If you've
and
got a
I want,
30% holding
yeah,
of the asset or the company, then
mm,
you've got a lot of sway, but you don't have to. Okay.
yeah, and you can push things in the direction that you want them to go, rather than, and it might mean that. So if I'm a superannuation fund and I've got this hidden leverage in my system, so it's going to make me a bit more volatile, but actually those assets they're unlisted anyway, so you're not even going to see that volatility because I've managed to hide that part, and it means that I'm using this extra debt. So over time, over a longer period of time, yeah, I'm going to get better returns than my other guys because I've used all this debt. I've got all this debt that I've
Yeah.
hidden in these other ones, and and so um,
All
yeah,
right.
the volatility, and I've taken a lot more risk with people than what's going on. By just gearing it up and saying, well,
The
it's not my
ratios
money, it's
look
somebody
pretty
else's
good
money.
now.
Let me roll the dice and off we go. Yeah. Okay, so that's another reason why
Two.
it's popular. Third one now, Host Plus is sort of gets a lot of slack, a lot of stick for this, but they basically put their unlisted assets, and they put them in the like a lower risk category. And so what happens is they basically, so ordinarily you go, okay, I buy a listed airport. Okay, that's a growth asset. Now they basically say, well, we bought this unlisted airport, and I'm using airport as, it could be a pipeline or whatever, toll road or any of these sort of assets. But they're buying an unlisted asset, and they're saying, well, no, we're gonna treat this like a debt instrument. We're gonna treat this like a bond because it's
Mm-hmm.
unlisted, it's low volatility, blah 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 blah, and so we're gonna treat it like a bond. And so what happens is when markets go well, Host Plus talks about how, aren't we champions because we outperform every other person? And the reason why they outperform every other person is because they're like, well, they own 80% growth assets, and they're comparing to all these people that are capped at 60% growth assets. And then when markets go badly, they're at the bottom of the pole. And so it's not because they are fantastic managers or whatever. And
So they have
uh,
40% bonds, but 20% of those are these
growth assets.
categorized unlisted assets.
Yeah,
Yeah,
and
right.
so
Okay.
it's basically just a measurement thing about saying, well, if I can compare myself to, if I can compare myself to people that I shouldn't be compared to, so
Mm-hmm.
think about it like a kid's sport. I'm a runner. I'm 16 years old, but if I can get myself classified in the 14-year-old category, then I'm going to be winning all these races. I might be coming middle of the pack in the 16-year-olds, or I might be coming last in the 16-year-olds. But if I can reclass myself as a 14-year-old, all of a sudden I'm bigger and better, and I can run. I can win the races. And that's effectively what you're basically saying is that, if you're comparing like with like, they may or may not,
Mm-hmm.
shape up as being good. But if they can get themselves reclassified into a different category, they can definitely make it look like their performance is better. And so, yeah, so that's another benefit of these unlisted assets. Um, uh, yeah, so a lot of it, and a lot of this all comes back to, it's this push pull between that you have in every company, but investment management just as much is that, are they working for the shareholders or are they working for investors? Or sorry, working for management, or they're working for the shareholders. So if I invest in a BHP, and they're like, we're going to double the size of our company, we're going to double the size of our sales and everything like that, and I'm going to award myself a much bigger salary, but earnings per share is not going to do anything. He's like, well, that's because as a manager, you want to get more money and you don't care about shareholders. And it's a similar, and so that's the agency problem that you have
Yeah.
is, okay, I need to make sure that my management's actually getting a return for shareholders. And so it's the same problem here, is it's saying, well, I can make all the statistics look good and I can make them look like I'm doing a great job. And then I can award myself much higher salaries and bonuses and all that type of stuff. But for investors, all that's happened is I've just run more risk than what I've told them, and
Yeah.
you
Mm-hmm.
know, so
And it eventually blows up, right?
well, yeah. Look, most of it, I guess the thing is, most of the time it doesn't blow up. Is the answer there? Every now and again it will, but and it's I guess it's this part about saying, uh, somebody's turned up and said, I want a low risk investment, or I want a medium risk investment,
Mm-hmm.
and you've turned around and given them a high risk investment. Most of the time, it's not going to blow up. Every now and again, it will, and there'll be devastating results. But in aggregate, they're probably going to get a better return, than if you actually did put them into the medium risk asset they asked for. The issue is you haven't got what you asked for. If you wanted a high risk asset, you could have gone to any one of these other people
Yeah.
and maybe got a better return or a better result from somebody who was actually saying, "Oh, Shelley, you're looking for a high risk asset. I'll give you one."
Mm.
It's
Yeah.
the dishonesty or the it's not dishonesty, but it's disingenuous in terms of about saying,
Opacity.
yeah, basically saying, you want a medium risk asset? Yeah, well, I can dress up my high risk assets to make them look medium risk, and I'll sell that to you.
Yeah. Yeah. All right. I feel like it might be a good time now to circle back to the question we started with. Obviously, we've talked about why it matters, but maybe just to reiterate, because I think we've touched on, but let's just kind of reiterate what are the things you can do about it if this is something you're concerned about. And I think maybe before I let you answer that, I would reiterate that we're not saying that you have to have transparency and you should divest your super straight away, but we are saying just be aware of what's going on and decide for yourself how you feel about it, and what that matters, how important it is for you.
Yeah, and the thing is, transparency is not going to fix a bunch of problems. What it's going to do is when you look and you say, okay, if I go through if I go through all the worst performers and the ones that have these big problems and blow up, what's usually the common denominator is there'll be an element of transparency that they don't have. So they don't have the transparency, and it means that management gets to hide problems or gets to push stuff aside, and until it becomes a bigger issue, and then turns into something else. Then you step out of that and you go into the transparency side. Okay, now at least everyone's on an even playing field. And if there are problems, you're going to see the problems early before they turn into something bigger. And so, management can't pretend things aren't bad. When things go wrong, they can't just pretend things are fine and hope things will get better. They actually have to deal with that problem. And so, it doesn't guarantee a great result, but it helps avoid some of the worst cases from the other part. So that's one part with the transparency. In terms of the transparency of pricing, look, this just comes down to, I guess, a fairness, and there's an element about saying, okay, well, if I'm in one of these funds and things do start to go badly, then often what I could do is I could sell my assets. I could sell out of that, and I could be the first one out the door and make off. I make. The assets have fallen 30%, but I get to sell them at the same price as what we bought them for, because the company hasn't marked them down yet. And so great, and I'll move to another super fund and go on. So there's obviously that, but for most people, they don't want to be moving super funds.
But there's also risk involved in that, right? In calling it.
And the danger is you're the one who's not really paying that as much attention, and you're the one stuck with owning all these assets because everyone else has chuffed off and your assets just aren't worth what you thought they were. And so so I think there's having that transparency. It doesn't guarantee you a great outcome, but it helps avoid the worst outcomes. And let's face it, that's what in terms of your superannuation, the last thing you want to find out is that you've just lost a whole bunch because of things of avoidable issues as opposed to unavoidable.
And so if you want access to some of those sectors that are typically unlisted, and you do actually, and transparency is important to you, what are your options there?
Look, in my view, there's not a lot of these assets that you can't get elsewhere now. Okay, so let's go through some of the bigger ones. There's a lot of infrastructure plays was where it used to be. There used to be, it was always about, you just can't get access to these things. There's enough now. There's enough listed assets out there now. Macquarie in particular was that was their whole business model for most of the early 2000s, was taking unlisted assets, bundling them up and listing them.
Now they're being taken unlisted though. It's in the Air Force.
Yeah, well, yeah, that's right. But there's there's lots of those ones, and especially once you look internationally, plenty of those assets out there. There's private equity, which is another part where you're saying, okay, well, and so what are you getting from private equity? The issue with the private equity, and especially over the recent years, is what they tend to be a more geared version of listed assets. Like they're basically saying, we've bought out some listed company, we've thrown a bunch of debt on it, we've gone and ripped out a bunch of costs, then we've tried to relist it before the problems start to evolve. Like the classic model is you say, you take a company, you get rid of all its capital expenditure and future costs, and then you look at how profit. Hey, isn't this great? We're not reinvesting anything, and look how much money we're making. We're raking the cash in, and then all the system's going to fall over in 3 or 4 years' time because you're not reinvesting, and so then you sell it off to somebody else before
But the
that
market's
happens.
put a 10 times multiple on the revenue.
Yeah, that's right. And you
Like,
gear it up.
wait, is Dick
And so,
Smith a good example of this one?
yep, absolutely.
I'll
There's
say,
plenty of those ones
hollowed
where,
that one out.
yep. And so I guess the issue with that is saying, is that if that's a market you really want to get hold of, there's plenty of other ways you can get hold of it. There's lots of private equity players out there who you can invest in. It's a bit harder through your super fund. You do it through a self-managed super fund, but
It's the same
I think
issue though, won't it be? Because the manager will be valuing the assets.
it is exactly the same issue you get with a private equity.
So
but if that's what you're trying to get to, is actually, sorry, is it exactly the same?
Or there's one less layer of people in between.
Yeah, that's right. It's a very similar problem. I guess the additional thing you don't have as much is there is slightly less of an agency issue in terms of it being okay. There's a bunch of other investors who have given money to this private equity firm, and they have invested in this private equity firm at arm's length, and so therefore they're more involved in trying to get the right prices for the assets.
Okay.
Whereas with a super fund, I've given my money to this super fund. They are both the private equity firm and the super fund. They're acting in with one hat. One hat they're working for me, and then they're changing hats, and now they're working for as a manager trying to get the best returns on this.
Okay.
Whereas that's not as you've got slightly less of an agency problem, but it's a very similar problem. What else were we talking about? I mean, there's some early stage, in terms of private equity, trying to get onto early, the really early stage stuff. Look, the returns in that are pretty hit and miss. So again, I'd say, well, is that somewhere you want? Maybe you want a small part of your super fund in that, but it's they tend to make not much money a lot of the time, and then suddenly hit home runs and get companies go up 10 or 15 times in value. And so so it's sort of a there are other ways you can directly invest in those ones, but there's I guess a lot of it comes back to saying, do we think superannuation funds have this core competency in terms of managing these assets? And I would say no. I don't think there's any reason why a super fund, for example, is better at picking private equity companies that are then better at picking stocks than others. And sorry, that was the wrong way to put it. An investor can go out and pick a private equity guy who then goes out and picks stocks, or things to invest in. If a superannuation company is effectively acting as a private equity or something themselves, then they have all the managers internally, and you're basically relying on them to hire the right people to then So and then they're going to be better at that than the private equity guys. I don't know if there's a definitive answer, but I think you've got a similar result, but with just an extra agency problem.
Yeah, right, sure. All right, so those are the main ones: the infrastructure, real estate, which we can both get listed, and private equity, which you have to get unlisted still.
What else can you think of? I'm trying to think of what else there is in the super fund, in the unlisted part, that they would. And look, part of this comes back to the whole. There was is it the Yale model or the Harvard model? I'm just trying to think they're right, but it was one of the universities. Sorry, apologies. I should have known that offhand. But it was anyway. The idea was that back 20 years ago, it was this whole idea that actually you can invest in these unlisted assets because you're a big fund and you've got a long time horizons, and you can make these great returns because of the liquidity premium that these other assets give you. And that was there's a whole theory around that, and it worked really well for a couple of funds. But then because it worked really well for those funds, that went away. But there's still that impression out there that there's this liquidity premium that you can harvest.
That is to me really interesting, because I certainly saw that so much demand from super funds for these unlisted. And I mean, if it is continuing now, and one aspect of the model that does work is that because of the relative age of superannuation in Australia, is that most of these funds are collecting net inflows. They're not net paying out yet. We haven't reached that peak where so many people who have super are retiring, they're paying out. So it does sort of support this unlisted model, this model of collecting them. And so even if, say, you're getting fair market prices, there's still so much demand there that you have to ask, well, is this actually really a fair price, or is that going to drop away at some point and then it's like all of the managers are left with their pants down as the tide goes out?
Yeah, well, and also what you've described there as well is these is the way a lot of these guys think about it. They're saying, oh yeah, we've got net inflows, and so therefore we can afford to do these whatever we're doing, and that's that works out for our business model. Is they're talking about themselves? They're not talking about you as an investor. They're basically saying, oh, because we've got a whole bunch of people doing something, you might be in pension phase and you might be going the other direction, but they're like going, well, yeah, but because we've got lots of more of these other guys, and we're catering to you. And I guess that's what part of the issues I'm coming back to is saying what they're effectively going, well, we have this pool of money that has got certain characteristics, and so we're going to now try and take advantage of those because that's what's good for me as a manager, which may not be what's good for my investor.
But in their defense, it's an aggregate problem that the whole system is going to face. So if you disaggregated each individual person who holds superannuation, then and then not allocating to unlisteds, you're going to have it tipped much more against them, because each individual, you explained at the start, is not going to be able to buy the unlisteds. And so if you don't aggregate them, you're going to have this huge premium in the listed space.
Yeah, well, maybe, but I think what you find is, and certainly we've seen in my view in recent years, is that the gap between listed and unlisted is got pretty small.
It's closed,
and
sure.
Yeah, and there should be a big gap, because if I invest in unlisted, I should get rewarded because I bought this really illiquid asset, and I should get this extra couple of % per annum because of it. And it's just not there anymore.
I do think that there's irrationality towards some of these investment decisions.
And it'll take a big blow up, at some stage.
But I don't think on that specific argument I don't think it's indefensible that the super funds are faced with this structure, and that's their response to it, personally.
Yeah, look, in terms of the way their cash flows work, and as long as they're big and everything's fine in a normal environment, there's nothing wrong with it. That's the way it will accumulate. Yeah, it's a question about, do I want one extra layer of risk on my superannuation, which is this risk that something can happen to my superannuation fund. And as you said, the Optus breach is a perfect example of that. You get a breach, all of a sudden all these super people have lost all their details, and you just get a big clear out. It doesn't even need to be performance based. It's just
exactly. Yeah.
And let alone if it is a performance based one, and you get a lot of people sort of shifting out. So
yes, lots of things to think about there. Damien, thanks for your time. Really appreciate it.
Yeah, no worries.
And your thoughts. So, do you want to let listeners know where they can hear more from you?
YouTube, we're up on every week. We're on all the major podcasts, Spotify, Google, Apple podcasts. We're up, and we write and blog a lot on Nucleus Wealth and a couple other places as well. So yeah, come along and subscribe, throw your email in, and you'll get notified whenever we write anything new.
Thank you. All right, so before I say goodbye today, I'd like to give my thanks to Philip for recommending this topic. I really enjoyed the conversation with Damien. I thought it was a really great topic. So please, if you have any ideas for topics, send them through to us at contact@nucleuswealth.com, as well as if you have any other feedback about this episode. Finally, if you know anyone who you think would get something out of today's episode, please let them know about it, share it with a friend or a colleague, and help our show grow. So thanks again from myself and the team. We look forward to catching you at the next one.
Nucleus Wealth, customized portfolios for engaged investors.